February 28, 2026. Buffett's successor, Abel, has released his first shareholder letter since taking the helm, sparking intense attention across the global investment community. For the past 60 years, this letter, penned personally by Warren Buffett, has tugged at the nerves of investors worldwide every single year. And this year, the inaugural letter authored by Abel hides a multitude of fascinating insights. First, the most pressing question on everyone's mind is, what happens after Buffett leaves? Regarding this question, the answer Abel gives in the letter, translated into plain English, is essentially this: shareholders, please rest assured, things won't change much. Why? Because the Berkshire culture built by its two founders, Buffett and Munger, over 6 decades will not and cannot be easily altered. To reinforce this, Abel details the 6 core pillars of Berkshire in the letter. He states that his goal for the next 20 years is to make this company even stronger. He also reveals that the 95-year-old Buffett, currently serving as the company's chairman, still appears in the office 5 days a week to provide them with necessary guidance. The market is also heavily focused on Berkshire's massive cash reserve, which sits at over $370 billion. Abel provides a clear explanation for this as well. He clarifies that holding this astronomical amount of cash is by no means a signal of retreating from investing, but rather to ensure they can act swiftly when opportunities arise. Regarding equity investments, Abel emphasizes the foundational principles of Berkshire's investments, while also affirming that investments in the Japanese market are quite important, having yielded substantial returns in recent years. In short, the biggest highlight of this letter isn't about creating new narratives, but about telling the market that after Buffett steps back, the empire of Berkshire will remain unshakable. As for how Abel will perform as the successor, we will all have to wait and see. Here is the full text of Abel's letter to shareholders. Let's take a closer look together. To my fellow Berkshire shareholders, Warren Buffett is arguably the greatest investor in history. Generations have benefited from his remarkable investment wisdom. At the same time, he is also an extraordinary chief executive officer. Since acquiring National Indemnity Company in 1967, he has consistently executed his vision of building an outstanding insurance business, masterfully using float to complete numerous successful investments across vital economic sectors, with a particular focus on the American market. It makes Warren rather uncomfortable that this letter opens with these observations, but we all know it to be the truth. In the past, Warren has spoken about how he drew inspiration from Ted Williams. This Hall of Fame baseball hitter divided the strike zone into 77 distinct cells and tried to swing only at pitches in a much smaller sweet spot, which led to a career 344 batting average and a historic 406 season in 1941. Similar discipline, patience, and judgment defined Warren's investment philosophy. Identify your preferred strike zone, wait patiently, and then swing decisively. But he is more than just a master investor. Together with his business partner, Charlie Munger, Warren built Berkshire into an enterprise built to last. Combining world-class capital allocation with vision and leadership, they created an enterprise fully prepared to transition from founder leadership to one ready for the next 60 years and beyond. Even more enduring than these achievements is Berkshire's 6-decade practice of treating its shareholders as true partners. Warren has frequently expressed his respect and gratitude for Berkshire's long-term shareholders. They constitute one of the most remarkable shareholder groups of any public company. Warren invested alongside us, candidly documented mistakes and successes, and welcomed us to Omaha every year for open, honest discussions. His annual shareholder letters and direct interactions at the Berkshire annual shareholder meetings are the clearest manifestations of the partnership commitment upheld by Warren and Berkshire toward us, the owners. We are incredibly fortunate to have Warren serving as Berkshire's chairman, working in the office 5 days a week, supporting us across our insurance operations, non-insurance businesses, and capital allocation, including equity investments. Warren will also continue as a Berkshire shareholder, though his shares will be fully donated to philanthropy within about 10 years after his passing. Investing in Berkshire has always been a vote of confidence in our founders. Today, that trust has been transferred to Berkshire itself. Your capital is commingled with ours, but it does not belong to us. Our role is stewardship. This stewardship has shaped a culture and solidified a set of values. They are not the result of our success. They are the cause of it. I am deeply honored to be appointed by the board of directors to serve as Berkshire's CEO. As the successor, writing this annual shareholder letter for the first time, I feel profoundly humbled. As everyone knows, succeeding Warren Buffett is no easy feat. The first step in taking on any leadership role is to understand the organization, why it exists, how its culture shapes its people, and what values guide its decisions. While you will notice similarities and differences between Warren, Charlie, and me, we share the belief that Berkshire is shareholder-oriented to an extraordinary degree. My understanding of Berkshire traces back to 1992, when I moved to Omaha to join Cal Energy, a company not yet affiliated with Berkshire. A portion of Cal Energy's equity was held by Peter Kiowitz's sons and chaired by Walter Scott, Jr., who also served as a Berkshire director. Walter had succeeded Peter Kiowitz as the company's CEO, and the leadership standard he set profoundly influenced me. My specific duties at Cal Energy back then are no longer important. What matters is that it was an extraordinary period of my personal development. I am grateful to have lived in Omaha, a city that represents a brand of capitalism rooted in fundamentals and driven by values. Its insurance, construction, railroad, manufacturing, and emerging energy industries are all anchored in the idea of building enduring enterprises. It was only after Cal Energy became Mid-American Energy Holdings Company and was acquired by Berkshire that I met Warren and Charlie. I admired how they worked together to build a business that embodied their business and life convictions. These convictions birthed Berkshire's culture and values, which continue to guide the company today, enabling it to withstand market cycles, volatility, and change. Our durability stems from a deep understanding of our identity and how we operate. This profound recognition of the role our culture and values play in our success is also shared by our unique shareholders, our partners in this endeavor. Through our interactions at the annual shareholder meetings, I've learned that you want us to succeed together, and to succeed in the right way. Berkshire's culture and foundational values form the cornerstone of our operating framework. It shapes the strategy and choices we make in building Berkshire. As CEO, this framework guides my leadership every single day. The horizon of our owners is never limited to the tenure of any single CEO. I clearly won't be the CEO of this company for the next 60 years. Simple math tells you that idea is, well, a bit too ambitious. However, I hope that 20 years from now, when my tenure will still fall far short of Warren's, you or your descendants will feel proud, because this company has grown even stronger. Berkshire's success relies on our nearly 400,000 employees. They are dedicated to implementing our culture and values across all Berkshire business segments, from See's Candies to Geico and everything in between, and adhering to them unwaveringly in any situation. This is the core of our progress. Our success is equally due to the leadership of the board of directors and their continuous alignment with our core philosophy. Last month, I addressed all employees, emphasizing that Berkshire's culture and values remain unchanged and will be passed down in perpetuity. Importantly, I am sharing with you the full text of that statement sent to employees, supplemented with some personal reflections based on my experiences at Berkshire, presented in regular font. While presented separately, these values are intrinsically linked and inseparable. Berkshire is a unique, diversified conglomerate designed to allocate capital rationally and efficiently. Insurance is our core business. Meanwhile, we also hold massive investments in businesses across numerous other industries. Our operating approach is designed to be the stewards of our shareholders' capital, supporting our goal of maximizing Berkshire's intrinsic value over the long term. We are committed to solidifying the great foundation built by Warren Buffett and his business partner, Charlie Munger, ensuring this legacy endures through our unwavering commitment to excellence. Our culture begins with a partnership mindset. Our shareholders are our partners. We have earned their trust and must work diligently to maintain it. Their interests are the core of our decision-making. This mindset exists far beyond Berkshire's corporate headquarters in Omaha. It extends to all our operating businesses. Employees uphold an owner's mindset, managing our shareholders' assets as if they were their own. We think in terms of decades, act with discipline, and honor our commitments. Stewardship runs through our operations, reinforcing our culture. It is a system that generates long-term performance, not just a set of beliefs. Charlie's comment on May 1, 2021, that Greg will keep the culture, will forever resonate with me. It reminds us that our culture is our most treasured asset. It is a clarion call to maintain Berkshire's core characteristics for a lifetime and a challenge to ensure our culture continues. When I led Berkshire Hathaway Energy, BHE, Berkshire's culture influenced how we operated. When allocating capital or evaluating potential risks, Warren's questions always cut straight to the point. Beyond that, we were given true autonomy to manage the business, always focusing on the customer and taking a long-term view. This owner's mindset is what every Berkshire leader should possess. Our core values. The following core values are principle-based statements that we fully endorse and strive to practice in our daily work. Decentralized management model. We seek the best managers to run our businesses, letting them lead talented teams. We use a decentralized management model, granting full autonomy based on earned trust. We minimize bureaucracy and give managers independence so they can focus entirely on business development. In return, we demand accountability and integrity in their performance. This autonomy attracts extraordinary talent to Berkshire. When I transitioned to vice chairman of non-insurance operations in 2018, leaders across the operating businesses asked similar questions. Would the decentralized model and their responsibilities change? I assured them no. I have personally practiced and witnessed the results brought by a culture that combines autonomy with accountability. Decisions made by those closest to the business and responsible for the outcomes are faster, better informed, and made with greater conviction. This will never change. Our CEOs never have to navigate layers of bureaucracy, nor are they forced to meet short-term earnings targets, which often lead to long-term value destruction. Our decentralized approach is a major competitive advantage, attracting managers who thrive in autonomy and can truly take responsibility. Berkshire must have leaders who embody its principles, rather than adapting its principles to fit specific individuals. Integrity. We fiercely protect Berkshire's reputation for integrity. This is reflected in the perfect alignment of how we think, speak, and act. The decisions we make uphold the company culture, communicating transparently and fulfilling commitments. A reputation for integrity is not claimed out of thin air. It is accumulated through long-term adherence to principled behavior. Every action reflects our deliberate effort to deepen trust in Berkshire. For over 25 years, at every annual meeting, we have played a clip of Warren's 1991 testimony before Congress regarding Salomon Brothers. Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless. Our commitment to integrity is unwavering and uncompromising. We know integrity is not a quality to be admired on a shelf, but an active quality that must be earned and continuously maintained day after day. We will experience business successes and setbacks. When we fail, we will openly admit it. Doing the right thing also means correcting our mistakes. BNSF Railway's resolution of a long-standing dispute with the Swinomish Indian tribal community in 2025 regarding crude oil transport across tribal lands is a great example. The BNSF decision that caused the dispute was made long ago, but current management built a partnership based on communication, understanding, and respect. BNSF acknowledged past mistakes and apologized, paving the way for a mutually beneficial agreement, allowing safe operations on tribal lands while meeting customer needs. In all our operating areas, we make daily choices about how to conduct ourselves. We have hundreds of thousands of good employees who act with integrity. However, in any large organization, there will always be a tiny fraction who fail to meet our standards. We have zero tolerance for such behavior. When it occurs, we will take decisive and thorough measures to address it. Maintaining our integrity and reputation is a never-ending journey. Rest assured, we will work relentlessly toward this end. Financial strength. We maintain a fortress-like balance sheet, ensuring Berkshire's foundation is never shaken. We preserve this financial strength by using debt sparingly and prudently. Our ample liquidity allows us to meet our obligations even under the most adverse conditions and to react swiftly when opportunities arise. Our balance sheet is a strategic asset to be deployed at the right time. It enables us to act decisively, invest when others hesitate or fear, and stand firm when financial storms hit. By maintaining low debt levels, we preserve Berkshire's financial resilience and independence. We will always be an asset to the U.S. and global financial systems, never a risk. Our cash and U.S. Treasury holdings now exceed $370 billion. While a portion of this capital is necessary to support our insurance operations and protect against extreme scenarios, it is also our reserve fund. Without a doubt, provided we do not compromise Berkshire's financial resilience, we will have opportunities to gradually deploy our shareholders' capital. My responsibility is to ensure our liquidity levels and capital deployment remain prudent and disciplined. We will always strive to own productive businesses rather than merely holding U.S. Treasuries. Capital discipline. We deploy shareholder capital into opportunities that offer corresponding returns based on a risk-to-reward match. Whether expanding existing businesses, acquiring new operating companies, investing in equities, or repurchasing Berkshire stock, we evaluate every opportunity based on its potential to permanently increase Berkshire's per-share intrinsic value. Berkshire's capital allocation principles and strategy guide us in identifying opportunities. This includes investing in businesses we thoroughly understand that possess enduring advantages and long-term economic prospects, partnering with high-integrity leaders who understand customer needs and act like owners, avoiding businesses that disrupt the social fabric or could damage Berkshire's reputation, moving quickly to concentrate capital on a few high-conviction ideas, and maintaining the discipline to let compounding work its magic. Despite our massive size, we pride ourselves on an agile culture. Large investment opportunities can be safely shared with us. We will respond quickly, and if we like it, it will not be subject to financing contingencies. For opportunities that don't fit our principles, we will quickly say no. For those that do, we will pursue them aggressively, even though we know the former vastly outnumbers the latter. Historically, observers have often assumed our massive cash holdings indicate a retreat from investing. This is not the case. We continuously evaluate numerous opportunities and will remain patient and disciplined, pursuing appropriate investment targets for the benefit of our owners. In 2025, our strategy led Berkshire to announce two distinct acquisitions, OxyChem and Bell Laboratories. OxyChem is a well-managed industrial chemicals business. We initially learned of it through our investment in Occidental Petroleum. Its production of chlorine and caustic soda serves fundamental markets, primarily construction and core industrial uses. Management prioritizes efficient operations over sheer volume, supported by an integrated asset base and low-cost raw materials. For Berkshire, this attractive addition will contribute cash flow to our operating segments. Last year, Warren received a letter from Bell Labs CEO Steve Levy, asking us to look at the family business he manages for the daughters of its founder, Malcolm Stack. Steve's letter was exemplary. Bell Labs meets an enduring need, rodent control. In Steve's words, it possesses high operating margins, excellent historical and future growth potential, is easy to understand and always a necessity, and has a strong management team. In our words, it is a business run by outstanding managers with enduring advantages and long-term economic prospects. Our only regret is that it wasn't 10 times larger. These investments are now key components of Berkshire's robust group of operating businesses. Some of these businesses require almost no additional capital and can return excess cash to Berkshire. Others present highly attractive investment opportunities whose value will compound over time. Share repurchases are another vital capital allocation option. When Berkshire's stock price falls below our conservative estimate of intrinsic value, we will repurchase shares, ensuring the action increases the per-share value for existing shareholders. If the timing is right, we may also acquire blocks of stock directly from large shareholders. These actions increase your ownership of Berkshire's businesses without you having to spend a dime. Berkshire's stance on cash dividends remains unchanged. As long as every dollar retained can create more than $1 of market value for shareholders, we will not pay dividends. The board reviews this policy annually. We maintain capital discipline across the board. Whether acquiring entire businesses, buying publicly traded equities, or repurchasing our own stock, and regardless of the size of our cash and treasury holdings, we adhere to this principle. We carefully evaluate value, act patiently, and hold for the long term. Ultimately, our holding period is forever. Risk management. We identify risks and work to manage the risk levels across the entire organization. Our management approach is decentralized, adapted to the scale and complexity of each operating business. We focus heavily on risks that could threaten Berkshire's reputation, financial strength, or long-term ability to seize opportunities. When it comes to risk management, Ajit Jain is textbook. His rigor in risk management and pricing has set the benchmark for the insurance industry. Any contract can face legal challenges, and the risks of new insurance lines are particularly prominent. We often have to set a current price for a business whose costs may not be clear for many years. Accurately pricing insurance risk is paramount. If the price isn't right, we walk away decisively. Of course, understanding and managing risk is equally vital for our non-insurance businesses. Before pursuing new or additional opportunities, each business must thoroughly evaluate its specific risks and develop mitigation plans. In all our businesses, it is our responsibility to understand risks and actively manage them. Operational excellence. We strive for operational excellence across all operating businesses. Our employees continuously work to exceed customer expectations, improve efficiency to enhance competitiveness, prepare for operating model challenges, and prudently reinvest in business operations. We recognize that performance fluctuates year by year. Therefore, evaluating a business's success is not based on short-term results, but on its ability to sustain and enhance competitive advantages and improve economic prospects over the long term. Berkshire's operational excellence is not a program. It is the result of disciplined decision-making across all business segments. This begins with safety protocols and permeates every aspect of how we serve customers, manufacture products, and compete daily. In February 2025, a major fire struck the Precision Cast Parts Corp. (PCC) facility in Jenkintown, Pennsylvania. Their response showcased the absolute best of the Berkshire system. All employees on site were safely evacuated. The team then worked closely with first responders, providing plant layouts and identifying potential hazards. Afterward, PCC supported the local volunteer fire departments, assisted municipal authorities, and conducted comprehensive environmental testing to confirm the area was safe. Simultaneously, the fire posed a severe operational challenge. The over 700 components produced at that plant were sole-source supplies for core aerospace customers. PCC CEO Mark Donegan and his team rapidly shifted production across domestic and international plants, successfully transferring capacity while maintaining safety standards, product quality, and delivery timelines, without causing a single customer line stoppage. This incident embodies the core of our operating model: decentralized leadership, clear accountability, and outstanding execution under extreme pressure. Pursuing excellence must be a continuous daily action. By focusing on customer needs, improving operational efficiency, and driving continuous improvement, we are creating enduring long-term value. In summary, these foundational values built Berkshire and give us the ability to succeed in the decades to come. Although we have explicitly outlined these values this year, we will publish them as an appendix in future letters and discuss how we practice them in every letter. Their impact is also clearly visible in our current corporate performance. Berkshire's performance. In 2025, Berkshire generated $44.5 billion in operating earnings. This is lower than the $47.4 billion in 2024, but well above the five-year average of $37.5 billion. This result highlights the resilience of our operating companies while showing we still have room for further improvement. Before diving into the details, it is worth reiterating a Berkshire tenet. Our GAAP net income can experience wild annual fluctuations due to realized and unrealized investment gains and losses, and must be viewed with caution. These gains and losses are crucial over the long term, but when evaluating Berkshire's annual operating performance, we always believe operating earnings are the best metric. Equally important is the cash our businesses generate. In 2025, Berkshire produced $46 billion in net cash flow from operating activities, compared to a five-year average of over $40 billion, underscoring our ability to seize investment opportunities across all business sectors. Insurance operations. In 2025, Berkshire's insurance operations achieved their primary goals: increasing underwriting profit and float in a highly disciplined manner. We own a collection of outstanding insurance businesses. Each operates with a long-term philosophy. Their performance reflects both their intrinsic strengths and a broader industry trend where, after years of necessary pricing and policy term adjustments, momentum began to slow or even reverse in 2025, particularly in the second half of the year. This means we may shrink our underwriting footprint in property and casualty for a period of time. While the year began with significant wildfire-related losses in Los Angeles, the Atlantic hurricane season was unusually quiet. For the first time in a decade, no hurricane made landfall in the U.S., which is the largest risk exposure area for our primary insurance and reinsurance operations. This reminds us that Mother Nature controls the wind, not Warren, and certainly not me. In 2025, our property and casualty combined ratio was 87.1%. Given our 5-year average of 90.7%, 10-year average of 93.0%, and 20-year average of 92.2%, this is an outstanding underwriting result for an insurer of our size. Our retroactive reinsurance business does not collect regular premiums and is excluded from these figures. When discussing our insurance operations, we must again thank and praise Ajit. For nearly 40 years, his judgment and discipline have shaped our ability to underwrite massive, complex risks with caution and precision. The organization and teams he built deeply understand the inherent limits and opportunities in mega risks. His example continues to guide our teams. This stability benefits us all. In our primary group, other primary P&C operations, market demand entering 2025 was solid. Pricing in most commercial lines was reasonable or improving. Over time, the continued influx of new capital into the market has led to downward pressure or narrowing increases in rates for several key lines. We always prioritize underwriting discipline over scale expansion. When pricing becomes less attractive, premium growth plateaus. We expect these primary operations to face continued headwinds in 2026 and beyond. In our reinsurance group, we face similar market dynamics. Traditional and alternative markets injected massive new capital into reinsurance, which, coupled with relatively mild catastrophe losses in most major regions in 2025, drove property reinsurance prices significantly lower. Meanwhile, in most casualty reinsurance segments, claims inflation continues to outpace pricing. As long as these market cycle characteristics persist, we expect our reinsurance premium volume to shrink. Thanks to Berkshire's unique structural advantages, our reinsurance team will maintain strategic focus. We have massive capital strength, enabling us to underwrite massive and unique risks. We give our insurance managers full autonomy to run their businesses without quarterly earnings targets or growth mandates that could distort their underwriting judgment. We view underwriting discipline as the most critical foundation for success in insurance. We focus on long-term development and resist short-term industry fads and overexpansion. The future market environment will strengthen those insurers committed to consistently improving underwriting profits rather than blindly expanding scale. Those focused on customer trust and loyalty rather than chasing short-lived market share spikes. And those building long-term resilience rather than chasing short-term opportunities. By year-end, our insurance float, the funds we hold to pay future claims while investing them for Berkshire's benefit, reached $176 billion. This is up from $171 billion at the end of 2024 and far higher than the $88 billion at the end of 2015. Under insurance regulations, the amount of ordinary dividends our insurance businesses can pay to Berkshire is restricted. For 2025, the maximum payout without prior regulatory approval was $31 billion. During the year, the insurance operations ultimately returned $29 billion to Berkshire, demonstrating the continued immense strength of their capital base. Our non-insurance group consists of robust businesses operating in railroads, utilities, energy, manufacturing, services, and retail, including Pilot and McLean. Berkshire's approach to managing its 51 non-insurance operating businesses differs significantly from most conglomerates. There is no hierarchical management, nor are there allocation targets or metrics set by Berkshire. Each business is accountable to its CEO, and the CEO is expected to relentlessly pursue operational excellence and close performance gaps. Capital allocation decisions for these businesses are ultimately made by me, as Berkshire's CEO, based on each business's opportunities and associated risks. Most operate with zero debt and will continue to do so. In these businesses, we made progress on fundamentals that drive long-term value, while also clearly recognizing where we need to improve performance. Regardless of the industry, our expectations are consistent. Managers should think like owners and execute rigorously, measured by results, not intentions. We are fortunate to have Adam Johnson managing our consumer, service, and retail businesses today. Adam has been steeped in the Berkshire culture for nearly 30 years, spending 10 of those as NetJet's CEO. He now oversees 32 companies. Adam and the NetJets team have always maintained an owner's mindset, earning industry acclaim over the past decade through operational excellence. Their efforts transformed NetJets from a struggling business model into a successful enterprise that consistently creates value for Berkshire shareholders. This ethos of accountability and rejecting complacency will guide him as he works alongside the CEOs of his respective companies. BNSF Railway. As one of the 6 major freight railroads in North America, BNSF is a critical artery of the U.S. economy. When Berkshire acquired this iconic business in 2010, the equity value was $34.5 billion. In 2025, BNSF generated $8.1 billion in net operating cash flow and returned $4.4 billion in cash dividends to Berkshire. For reference, its average annual dividend over the past 5 years was $4.1 billion. Safe operations, reliable service, and a competitive cost structure ultimately determine the success or failure of a railroad. And this is how we evaluate management's performance. BNSF is constantly working to optimize all three. Safety remains the top priority, and BNSF has maintained industry leadership over the past decade. In 2025, terminal dwell times dropped significantly, and network velocity reached levels rarely seen in the company's history. These gains are important, but far from enough. We need more progress to translate operational improvements into stronger financial results. We believe operating margin, the inverse of the industry's operating ratio, is the best metric of performance. In 2025, BNSF's operating margin improved to 34.5% from 32% in 2024, slightly above its 5-year average. However, the gap between BNSF and the industry's best remains too wide. Closing this gap requires continuous improvement in efficiency and service. Every 1 percentage point increase in operating margin brings roughly $230 million in incremental operating cash flow for our owners. The team recognizes the significance of this opportunity. If we do not see significant improvement in the coming years, we will be deeply disappointed. Beyond BNSF's internal improvements, the proposed merger of Union Pacific and Norfolk Southern may lead to further industry consolidation. Berkshire has explicitly stated it is not interested in acquiring another Class I railroad, as current economics would not bring value to our shareholders. BNSF's focus regarding this proposed merger is to ensure it can continue to provide a compelling value proposition to customers, including comprehensive and competitive access to Eastern rail markets. Berkshire Hathaway Energy, BHE. BHE's goal is clear: provide customers with economical, reliable, full-spectrum energy services. As the industry enters a massive investment cycle, this responsibility grows heavier. The surge in electricity demand driven by AI computing, combined with severe wildfire risks, especially in the American West, is fueling this cycle. We welcome industry growth, but this cannot come at the expense of affordability and reliability for households, small businesses, and industrial users. BHE proudly continues to provide tremendous value to the customers in its markets, with rates averaging 24% below the national retail average, and all its markets at least double digits below that benchmark. Infrastructure built for hyperscalers and data centers must be paid for by those customers and reflect the risks associated with step changes in long-term demand. BHE will only pursue this incremental growth and invest shareholder capital when the risks and rewards are appropriately balanced. Regarding wildfire risk, BHE consistently plays a leadership role, actively collaborating with regulators, public officials, and communities. Its risk mitigation measures are among the most comprehensive in the industry. When BHE's utilities are liable for wildfires, they never shirk responsibility, including PacifiCorp's settlement agreements regarding the 2020 Labor Day fires. At the same time, PacifiCorp is not the ultimate risk bearer and should not be treated as an entity with infinite liability. For liabilities it should not bear, the company will continue to seek exoneration through legal channels. This stance of accepting responsibility, while on principle opposing unreasonable compensation, is vital to maintaining the regulatory compact of public utilities. As the team adjusts its strategy, BHE is rebalancing its portfolio. In 2025, while navigating multiple challenges, BHE still generated $8.4 billion in operating cash flow, in line with its 5-year average. Our willingness to invest continuously depends on whether the regulatory compact can consistently guarantee a reasonable return on capital investments for utilities. While near-term opportunities are massive, BHE will proceed with a prudent, selective approach. Manufacturing. Industrial products. Although the macroeconomic environment for our industrial products was challenging in 2025, the earnings performance demonstrated inherent resilience. Group-wide operational execution was strong, particularly at Precision Cast Parts, PCC, Marmon, IMC, and Lubrizol. This sets a solid foundation as they seek incremental opportunities. The Lubrizol team, led by Rebecca Liebert, played a key role in acquiring OxyChem and planning its integration as an independent Berkshire business. In addition to her role as Lubrizol's CEO, Rebecca now oversees the OxyChem business and will work alongside OxyChem CEO Wade Alleman and his team. Our largest industrial manufacturing business, PCC, spent most of the past decade navigating a tough aerospace market. Slowed aircraft production, declining volumes, and disruptions, most notably the pandemic bringing air travel to a halt, kept margins under pressure. The PCC team has now weathered the worst. Air travel has recovered, aircraft orders have restarted, and demand for the company's components has normalized and is growing. Throughout, the business maintained strict discipline. Management is focused on converting a healthier industry backdrop into margins that better reflect its long-term potential. In 2025, PCC generated $2.4 billion in net operating cash flow, compared to an average of $900 million in 2021-2022 and $1.7 billion in 2015, the last full year before our acquisition. Manufacturing. Building products. Our building products operations serve the U.S. residential and commercial construction sectors, from homes built by Clayton to materials and finishes supplied by our other companies. Like any market, consumer preferences change, and our businesses must adapt. Shaw Industries went through a challenging period as consumers shifted away from soft flooring. Some of this was self-inflicted. During their expansion into hard surfaces, execution lapses impacted product quality and service. Shaw is now rebuilding its manufacturing system and restoring necessary operational discipline to win back customer trust. Clayton is a giant within the group. Its business model centers on the efficient manufacturing and construction of quality homes, supported by integrated financing. This has proven resilient against short-term volatility in the broader housing market. This model enables Clayton to meet the persistent national demand for high-quality, affordable housing. While building products activity fluctuates year to year with broader construction trends, The long-term demand for housing and commercial construction remains robust. This gives Berkshire a positive outlook for these businesses, which are known for disciplined, knowledgeable management, an intense focus on the customer, and proven operating models. Services and retail. As highlighted earlier, Adam oversees Berkshire's consumer, service, and retail businesses. In 2025, despite highly challenging environments in some consumer sectors, these businesses generally performed well. NetJets is the largest business in our service group. NetJets remains relentlessly focused on safety and exceptional service to solidify its position as a premium brand. This foundation attracts numerous customers. Today, it operates nearly 1,100 aircraft across over 150 countries. In a fiercely competitive industry, this is a precious asset. Pilot continues to strengthen its operations. As North America's largest travel center operator, Pilot competes on location, service, and reliability. Management is laser-focused on store-level execution, elevating the customer experience for professional drivers and everyday travelers, and investing in store upgrades, food offerings, and loyalty programs. Since 2023, Pilot has increased capital expenditures to modernize facilities and expand its EV charging network. These efforts are reflected in Pilot's Professional Preference Score, a third-party metric tracking how often professional drivers choose Pilot over competitors. This ratio rose from 27% in 2022 to 35% in 2025, placing the company second in the industry. We deserve to be number one, and we will not be satisfied until we hit that mark. We initially invested in Pilot in 2017, but due to contractual agreements, our management control was delayed until 2023. We will not make this kind of mistake again. The economic foundation of the business is its cash-generating ability. In 2025, Pilot generated $1.7 billion in operating cash flow, an improvement over 2024. As operations continue to strengthen and capital needs normalize, we expect more cash to be returned to Berkshire. Equity investments. We apply the same core value of capital discipline to Berkshire's equity portfolio as we do to our operating businesses. A significant portion of our portfolio remains highly concentrated in a few American companies, such as Apple, American Express, Coca-Cola, and Moody's. We understand these companies deeply, highly respect their leadership, and expect their value to compound continuously over decades. This concentrated approach will remain. You should expect only limited activity regarding these holdings, but if we see fundamental changes to their long-term economic prospects, we may significantly adjust our positions. The same standards apply to our investments in Japan. We view them as equal in importance and long-term value creation opportunity to our core U.S. assets. Berkshire's borrowings in Japan roughly match our yen-denominated investments. On a cost basis, the average interest rate on these borrowings is 1.2%, with a weighted average maturity of roughly 5.75 years. Combined, the market value of these Japanese holdings at year-end was $94.0 billion, making up nearly two-thirds of our $297.8 billion equity portfolio. These holdings generated $2.5 billion in dividend income. Against our $24.5 billion original cost, that's a 10% yield. Additionally, we hold large positions in a few other companies. Because relative valuations and opportunities are constantly shifting, our capital allocation in these investments has been more fluid and dynamic recently. Over time, if the fundamental business characteristics of these companies are consistently validated, they too could become part of our core holdings. We also hold equity method investments, primarily Kraft Heinz and Occidental Petroleum. Our investment in Kraft Heinz has been disappointing. Even accounting for the preferred stock in our initial investment, the returns have fallen far short of satisfactory levels. At Berkshire, equity investments are a core component of our capital allocation, and the ultimate responsibility rests with me as CEO. Ted Weschler currently manages about 6% of our investments, including the portfolio previously managed by Todd Combs before his passing. Ted's impact goes far beyond these investments. He plays a broader role in evaluating major opportunities, providing valuable input to our businesses, and supporting Berkshire in many other ways. Berkshire's foundation is unmatched. We possess an outstanding operating framework. Our culture and values shape our strategy and guide our leadership. We also have an extraordinary group of shareholders. Insurance will remain our core business. While its results will fluctuate with industry capital conditions, sometimes violently, this core of Berkshire will only grow stronger over time. This reflects the structural advantages defining the business. Our non-insurance businesses generate substantial operating earnings and recurring cash flow. A relentless focus on operational excellence will strengthen this portfolio and lay the groundwork for even greater long-term value creation. Our investment portfolio, more accurately, our equity portfolio, will evolve and expand as opportunities arise. This portfolio is an inseparable extension of our insurance operations and capital base. When valuation conditions are sufficiently attractive, we will return capital to shareholders efficiently and prudently through share repurchases. Given Berkshire's massive size today, the mathematics of compounding act against us. This reality has long been acknowledged, and the best approach is to frankly admit it. Our opportunity lies in continuously increasing per-share value over the long term. Even if this progress can only be achieved in smaller increments, we will always prioritize managing downside risk for our owners. The value Berkshire creates comes from the daily judgment and leadership demonstrated across our operating businesses. As shareholders, we are fortunate to have a board of directors that clearly understands and staunchly supports Berkshire, including our culture and values. Their diverse skills, experience, and perspectives benefit the company's governance immensely. Warren and Charlie laid the framework for this alignment. As chairman, Warren's extraordinary judgment continues to be heavily relied upon. Last December, we announced that Berkshire's CFO, Mark Hamburg, will officially retire on June 1, 2027, and will transition his CFO duties a year earlier on June 1, 2026. As successor, Chuck Chang will shoulder immense responsibilities. Before fully beginning his well-deserved retirement, Mark will assist Chuck in smoothly transitioning into this new role. To me, Mark has always been an invaluable partner. As Warren has said, Mark is indispensable to Berkshire and to me personally. His integrity and judgment are immeasurable, and he has done far more for this company than many shareholders know. I completely agree with Warren's assessment. To further strengthen our corporate headquarters, we recently welcomed Michael O'Sullivan as Berkshire's first general counsel. He will provide legal support to the group while safeguarding the company culture. Clear and candid communication with our shareholders remains the core of our partnership. Berkshire will always insist on communicating information to all shareholders simultaneously through the same channels, ensuring you have the necessary information to evaluate the company's performance. We focus on quality, not frequency. If major issues arise, I will communicate with you. But given our long-term perspective, this will not happen through quarterly commentary. The next time we gather as owners will be at our annual meeting in Omaha on May 2, 2026, our Shareholder Day, or what other companies might call Investor Day. The familiar schedule will guide the day's events, centering around open communication and direct interaction. Your questions will be answered in the same impromptu manner during the Q&A sessions hosted by Becky Quick. We also look forward to shareholders gradually getting to know the Berkshire team better. This year's event will include a CEO update report from Berkshire and 2 Q&A sessions, one hosted by Ajit and myself, and another featuring Katie Farmer of BNSF, Adam Johnson of NetJets, and our our retail divisions, and myself. Katie and Adam will discuss the challenges and opportunities in their respective businesses. This way, we will comprehensively cover both the insurance and non-insurance operations. Though each session will have a different focus depending on the participants, shareholders are welcome to ask me any question at any time. More details are in the annual report. The Board of Directors, CEOs, management, and I look forward to welcoming you to Omaha and continuing our partnership. Berkshire's extraordinary achievements are rooted in the relationship we maintain with you, our owners. I am deeply honored to shoulder the responsibility of continuing to build this company and deepening our partnership in the years ahead. We move forward with resolute determination and purpose. Greg Abel, CEO, February 28, 2026.